This episode of the Planet MicroCap Podcast is brought to you by Friedman LLP, a top 40 global accounting, tax, and business consulting and advisory firm, providing a full spectrum of services for public and private companies since 1924. Contact Friedman when you will need to raise capital and adhere to U.S. standards. The Friedman partners will work diligently with you to provide the financial assurance, regulatory, and transactional services you need. When the stakes are highest, Friedman makes sure you are well equipped. For more information and to get a Friedman free consultation, please call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com. Again, for more information and a free consultation, call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for your support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 178. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. Save the date. We just announced our next virtual conference, the SNN Network Summer Virtual Event, which will be held on August 17 through 19, 2021. The website is now live, and you can find the full details on the event at conference.snn.network. Registration is now open, so click register button once you're there to receive all the updates on speakers, presenting companies, sponsors, the works. So I look forward to seeing you all there at the SNN Network Summer Virtual Event, August 17 through 19, 2021. Conference.snn.network is the website. I'll see you all there. For this episode of the Planet MicroCap Podcast, I spoke with Thomas Braziel. He is the founder and CIO of 507 Capital. The microcap universe, believe it or not, is not huge. Shocker, I know. But so many of our guests said I should meet Thomas Braziel. He looks at the weirdest of the weird, the most out there ideas. Luckily, Tom has joined me on several of the Investors Roundtable episodes, and we're finally taking the time to highlight him here on Planet MicroCap. We chat about why he's a big fan of the stake and sizzle style of investing, as well as many examples of how he's utilized this strategy. So thank you again for tuning into episode 178 of the Planet MicroCap Podcast, and please enjoy my interview with Tom Braziel. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And our guest today is the international man of mystery. No, it's not Austin Powers. It is, well, maybe, I don't know. He might be, maybe he's the Austin Powers of microcap, you know? Right? Don Tommaso Braziel.
Oh, I'll take it. Don Tommaso.
That's right. He's the founder and CIO of 507 Capital. Tom, what's going on, man? How's life in Italy?
Nothing much. It's actually getting a little hot. It's the summer here. I'm at the top of my house, like the top of the house we rented, like the top bedroom, which was great in the winter. It was always warm. But now in the summer, conversely, heat rises. It's quite a little toasty in here, but I'll survive. I'll survive.
All right, well, don't worry. We're not going to keep you on the hot seat. Okay, man. We're going to ask you very dull, chill questions, so that we can let you out of here and go continue to be the Don Tommaso that we all know you want to be. So, but look, this has been a long time coming. Look, the microcap universe is not a big universe, but I've had so many people on the pod or on the roundtable that are like, oh yeah, you got to bring Tom on, or we got to have him on the roundtable, because you're seemingly either out front friends with everybody, or everybody happens to know you. So
I'm a friendly guy. It's not because of the ideas. It's because I'm friendly.
That's for sure.
Okay. Yeah, no, it's great to be on the pod, and thanks for having me. And that's very kind of you to say. I'm basically like most of the microcappers out there, gainfully unemployed and probably unemployable. And as I think I said on one of the pods where we were with Steven, with Steve, was it's kind of like a disease. You sort of are into this stuff. I think people are in microcaps not because it's microcaps. It's because of where the best deals are. You're kind of like, I want to say garbage hunting, but you're sort of like, maybe it's dumpster diving. I think distress is really dumpster diving, but there's a lot of interesting opportunities in special sits. If for an enterprising investor, the old Graham idea of being an enterprising investor. So that's why I'm down here. It's not because of
It's funny. I was making, I don't know if it's a good joke, but I was making a joke the other day to somebody where it's like, look, there's really only two ways you get into microcap. One, your family or somebody who's a close friend or colleague introduced it to you to go and check out everything, or you did all your due diligence and you read all the books and you're like, I think I'm going to get my start in microcaps. I mean, look, I've been doing this long enough where that seems to be the two circles. And there's not a lot of in the circle Venn diagram kind of thing. I don't know. I
think so. Yeah. Right? I also think it's like, if you do any like quantitative screening and you don't add any like microcap filters or, sort of market cap filters, you'll see like at the top of the list are like really small companies. And you're kind of like, well, why is this company so cheap? And if you're speaking to someone who's like more institutional, they'll say, oh, well, that's a tiny company that you just throw that out because, we can't really buy much of that, or we're not allowed to buy things that smaller. It's OTC listed, so we can't buy that. And I think the natural, like, sort of first principles response would be like, well, why not? And they're like, well, we can't really make a business out of it. Okay, that's a problem for you, but it's not a problem for the security or the guy investing in it, right? So I think that's why they exist. They're not aberrations. They're not value traps. And I see people like talk about factors where they sort of like add in, well, small cap this, and it's just kind of plainly obvious that the stuff is much cheaper. I mean, the quid pro quo is that they're probably less liquid. And if you have real amounts of money as a family office or just a wealthy individual or an institution, it's very hard to make a business out of it or to buy, more than $1 million. I was talking to my broker earlier today. I said, I really like this warrant. I want to start buying it. He said, just do you can only buy like maybe $5,000 a day. I was like, oh, right. Okay, we'll start buying it. So that kind of thing is good. And I think, who says this is, now his name, not one up on Wall Street. Help me out. Greenblatt. Greenblatt. Yeah. Greenblatt says like, the great thing about, getting good at special situations is you normally make money, and then you make money and you can't do it anymore because you get too big, and he's not wrong. You sort of like, even I'll have people talk to me, they'll call me or they'll email me, or, I love Twitter. If someone's on Twitter, DM me like a $4 million stock. And I'm like, hey, that's really cool. I mean, maybe I can buy $100,000 of this. Not to say that I'm not willing to be illiquid. It's just how much is actually out there. Like, what's the free float? And then if there's a rights plan, like my favorite is when you'll see a $5 million stock. Bobby, I'm sure you've got, and then they'll have a 382 plan, right? So you can't go above 5. So it's a 5 million, you can't go above 5. So then, what's the max position? Is that $250,000? So basically the max position is 250. And so I always joke that like, hedge fund, need not apply because like only PA. And what's interesting as well is you find a lot of good work. So a lot of smart guys are either in hedge funds or just investors in general on the side. They're down here doing a lot of decent work on companies. But anyway, I digress. Well, who do you want to talk about?
I figured I'm having you on. This is our first one-on-one interview, and I don't even know how you got to where you're at today. You know, we went right from like having met to best friends without like kind of
Besties.
we didn't really kind of do the in-between part where we were, you know, like get to know each
I'll
other.
give some background.
You know? So what's going on? How did you get? How did
No
507
foreplay?
Capital start? No
more
foreplay.
foreplay.
We're going right digging in deep. Okay.
Yeah.
I don't want to know your favorite sports team. I just want to know the background. All right.
I mean, I don't know why. I'm sure. I don't know. Okay, I'll try to be as brutally honest as possible because I feel like that's the only way to get to real valuable insight, hopefully. But so I ran a hedge fund for like 8 years. I can go further back. I was born in but I ran a hedge fund for about 8 years called BE Capital. That was okay, successful. I learned a lot about investing. I highly recommend anyone that wants to be an emerging manager launch a fund. It will be very hard to raise capital. And there are lots of reasons for that. And anybody that wants to hear about it can DM me or whatever, or you can reach out to me. You will learn so much about yourself, about investing, about business, starting your own company, and starting a small hedge fund, trying to be an emerging manager is a great way to do it. So I learned tons about investing. God bless the LPs that gave me money because I really didn't know what I was doing from a lot of standpoints. So let me go into that. So I spent 8 years doing that, and then I shut that down and started 507. We're really working directly with family offices. My sort of day job, quote unquote, is looking for sort of private distressed opportunities, generally credit. So we're doing DIP loans, alternative loans. We run a pretty sizable bankruptcy trade claim book for them. What are bankruptcy trade claims? This is busted AR. Let's say, Bobby, you have a company that I don't think you do this, but they do a sponsored video with you and you do some sponsored content. They owe you $10,000. Company goes under. You have this accounts receivable for 10 grand. We'll buy that for 2, 3, 4, 5, 6 grand, depending upon the recovery in bankruptcy. And we're basically sort of factoring the invoice. We're buying it for 5, hoping to make 10, or we're buying it for 6 to make 8 or whatever, depending upon. A prime example would be Hertz. Hertz files for bankruptcy. It's now 100% rebate case. We're buying claims, 80, 90 cents on the dollar to make $1 in hopefully less than 6 months. So that's a very high return business. Their taxes on it can be, it's all kind of short-term cap gains. So it has the tax drag, and it's a lot of work. So that's my day job. And of course, I still like looking for special sit equities and stuff like that. And I do that with my own money. And I have a whole lot of money in the stress stuff we do with the family offices we work with, because of course they require that. So how did I get there? I mean, my parents were bankruptcy lawyers. I grew up sort of a middle-class kid in Savannah, Georgia. And when I launched my fund, I was trying to do everything. I thought I wanted to be like, everyone wants to be Warren Buffett, or I should say everybody, but I wanted to be Warren Buffett, and I was going to launch a Buffett-style partnership. And, the feedback initially was like, well, Tom, no offense, like that was 50 years ago. Like, no one does that anymore. Now everybody specializes in something. So I kind of said, I think I know what I'm doing. I'm going to do whatever I want. So I was doing special sit equity, value equity, and distressed. When I looked at the attribution of returns, by far the highest returns are really coming from the distressed stuff. Basically because the large distressed funds it's kind of nice when we were talking about microcaps and the opportunities. Often run distressed is very hard to scale. If you're doing sub $10 million deals, sub $5 million deals, buying small accounts receivable, and you're doing it in at some scale, have a book of, I don't know, call it 10, 20, 30 or $50 million of trade claims. That's very hard for a large, firm to make money at. I mean, it sounds crazy, but I mean, if you run $1 billion plus or a multi-billion dollar multi-strat fund or a distressed fund, the smartest guys, they get there, and then $100 million at work in a bunch of small deals is like, can I curse? It's just not worth their time. So that say they made so much money, they move on, and that leaves more opportunity for you. So what else did you want me to? Let's see, background on myself. Yeah, so that's basically it. I mean, and I would invest money. I've said this before on a panel, so I feel bad saying it again, but I don't think I'm the world's best investor by a country mile. And I just look a lot of stuff. I just try to look at as much stuff as possible. And I try to use the heuristics that over time have worked for me. And for me, one of the biggest things in my philosophy, Bobby, and then we'll have questions, because I mean, I don't know, man. I don't want to
keep going, man. I'm not going to stop you. Keep going. This is
one of the for me. I almost want to say I'm not a value investor because I don't want to be in the club. I think it's costly to be in the club. It's costly to be in that comfort. For me, I'm a steak and sizzle guy. And that is a quote from steak and sizzle is, of course, stolen. Everything, all my ideas are stolen. It's taken from Michael Price. And Michael Price likes to say, I want a good valuation and I want some serious sizzle to it. I don't want to pay for the sizzle. And I've really tried to apply that philosophy. And that's been the most return for me. And the ideas that have worked have been those kind where I don't get hurt too bad if my sort of thesis doesn't play out. But if it does work out, I can make, unconscionable multiples of my money. And those have been the best ones for me. Other people have different strategies that have worked. It's, I guess, an offensive strategy compared to a more defensive strategy. And I think there are lots of approaches and philosophies that work. You have to find the one that works best for you. So can I go through one example that might highlight okay.
Keep going. Yeah. I'm not going to stop it.
So again, I want to be open so that people really get, because I hate it when people give generalities and you're just like, what does that mean? I don't know what the guy's talking about. So one of the biggest things that's worked out for me was I started buying these Mt. Gox bankruptcy claims years ago. And at the time, Mt. Gox was, just to give some background, it was a cryptocurrency exchange that went under in 2014. It was the largest exchange. It was 70% plus of the volume. I've done lots of other stuff, and actually the highest IRR is probably a different trade, but I'll go through this one because it's illustrative of this idea. When we were first buying claims, Bitcoin was at $300 a claim, and we were buying them for $100. The trade wasn't that interesting because you were basically just buying crypto at a third of the price. This is back in 2000 and I can't remember, 16, I want to say. Sorry, I keep getting notifications that I have to get rid of so I can see you, Bobby. I should have turned it off before. Actually, maybe I can, but whatever. So we started buying them at a third of the workout value. I thought this is really interesting because if you think about it, if this really works, you're getting 3 times this magnification. Now, I'm not going to put my whole portfolio in this, but if you made this 5% of your portfolio and people are right and it goes up 100x, crypto guys are right, well, shoot, you're going to make 300x. That's really interesting. I'm basically taking if you had a distribution, if you didn't know the distribution and then you take it and you go put it all in your favor by taking all the expected values and increasing them by the structure of the trade. I thought that was super interesting. So I started doing that a little bit. I pitched it to a number of hedge funds in New York. Bobby, you'll like this. So the first person I pitched this to was working at a shop. He won't remember any of this and he won't listen to the podcast. So I'll say it. It was a large distress firm. And I remember exactly where I was. I was talking to him about it. And I said, well, there's this bankrupt, there's this bankrupt cryptocurrency exchange. He said, cryptocurrency? And I was like, well, I'm buying claims. He said, cryptocurrency? And I was like, yeah, cryptocurrency. He's like, he said, you mean Bitcoin? And I was like, yes, Bitcoin. And he was like, he just sat back in his chair and he was like, that is the funniest thing I have heard all week. You want me to buy Bitcoin, Tom? And I was like, no, let me explain. But, anyway, that you get a lot of that in larger institutions where there's principal agent issues, just like in a bigger corporation where there's not a lot of stock ownership. So fast forward, the best time to put on the trade was when the trustee had sold a decent amount of crypto and basically raised cash. And we were able to buy the claims under the cash value and we were getting the crypto for free. That was the best time to put the trade on. That was 2018 before the case flipped from a pure liquidation to what's called a civil rehabilitation. So long story short is I was pitching this to everybody to buy into this trade. And there were some special sit guys that were like, hey, if you can get me the crypto for free, I'll put this on. So they really saw to me the convexity of the trade. But a lot of them, I find this too, even with special sit guys and microcap guys, they get a little too fixated on when the price they heard about the trade in and what they have to pay. They're like, oh, well, I heard about this at $5. It's now at $7. I can't buy it at $7. And then they missed the move from 7 to 30. And I'm like, well, the stock doesn't care that you found out about it at 5. So So I think people get very anchored to that. So we bought a lot. I bought a lot personally. I put just an enormous amount of capital, basically all of my net worth, into these claims. And also, we were able to get a family office on board. And that's worked out to be, of course, because of crypto, even with the big pullback, an enormously profitable trade. We actually made more on my principal investments than on the promote on that we got from the family office, and we now buy them for a large crypto hedge fund. But I mean, and it doesn't matter how much you made. It's really just about the generalization of this is what you're always looking for. I mean, to me, I'm always looking for a mispriced bet. That's all I really care about. I think I was on Toby's podcast like 2 years ago.
Yep.
And I was talking to him, and I was like, well, I'm kind of looking for like the setup, and I kept saying setup because I remember listening to it, and I was like, why do I keep saying setup? To me, it's really just like, am I getting ridiculously compensated for this risk? I feel like sometimes in my approach compared to other people's is the guys will say, well, you could lose money on that. And I'm like, I know I could lose money, but the question I'm asking is, am I getting compensated for potentially losing that money? So that's my approach. And I guess in a nutshell is I'm willing to take risk if I'm getting compensated. And it works. Of course, sometimes you get bludgeoned by this kind of approach, but it's worked for me. And, luckily I've had some that have worked out. And I don't think it's just about being like the world's best analyzer of businesses. But it does help to know a decent amount, and it does help to do due diligence. Don't get me wrong. It also helps for me. I think the most valuable information, like Bobby, you talk to a lot of companies, you actually talk to management. I'm not saying talk to management, but picking up the phone and getting scuttlebutt, I mean, it's just amazing to me that you'll meet guys and they'll be like spreadsheeting. And, there's so much more value in scuttlebutt, and I guess some people refer to it as channel checking, but it's not just channel checking. It's just scuttlebutt. And anyway, so that's kind of how I would approach it.
Hey,
Ask me something.
No, that was, hey, look,
please.
When you're cooking, Tom, when you're cooking, I'm not gonna let you stop, but, so one of the funniest introductions to you that I had was from Gary and Eric from, the hosts of In the Market Trenches. And the best,
who
the
are
best,
they again? No,
yeah,
they're good friends. Yeah, go ahead.
The best. And so they, they said, look, when you get Tom on for the roundtable for anything, he looks at the strangest, weirdest stuff ever, And and the thing that I always go back when I think about whenever you're going to be on,
don't you guys look at weird shit?
Yeah, I mean, we look at weird stuff, but then like when we actually hear about, then you talk about Mt. Gox bankruptcy claims. You're like, all right, that's just fucking.
No, but I use distress as a tool to try to get the stake and sizzle. But the idea is stake and sizzle. Like I just put on this Gettiker's trade basically after the placement. The Nantai, I just happened to. For me, I don't like screening. I mean, the screens are fine. I love getting ideas from guys that are looking at securities. I love watching the price. If I see something down 20% or 80%, I'm like, whoa, what happened? Like for me, I want to run to the fire and figure out if, they're going to be able to put it out. And if they can, like that can be an interesting situation. But so why do they say that? Go ahead.
Well, so what are the things that you look for then when you see that fire? And you, what are some of the questions or things that you look for there?
I'm like, okay, fire's not as bad as everyone says.
Yeah. No. How do you judge how strong the hose is or how good the water pressure is to put this fire out?
I don't always know. Most times it's a pass because I can't figure it out. Sometimes, most of the times, I think some big mistakes I see people make is people buy securities. Like why? Like you don't have to buy all this stuff. Like you can just wait, just own cash. And then if you're like, oh, I really like this, then buy. Like you don't have to do anything. If you run money as a hedge fund or a mutual fund or family office or something, and you have to put money to work, I understand there's probably pressure to put money to work. But if you're talking about people in your PA or just guys looking, they're just trying to compound their money or just wait, just don't swing. So for me, if I see a mispriced bet, it just has to be a matter of quantitative and qualitative, like looking at the setups. Okay, for myself, like day to day, I love using Twitter. I of course still use, valuation screen. I love just trolling on NetNets. I love trolling backorder markets. Like recently I was talking with a few friends about Italian small cap markets, because there's actually a lot of Italian listed companies. So some certain jurisdictions have a lot of small caps. It's not about small caps. It's about getting a good deal. So I will look at larger caps compared to maybe some of the people that just do small caps. Let's see, what else? I will buy expensive securities that I think are cheap compared to relative value. I'm not scared of that. I mean, sometimes, you have to say, like, I remember, what was it? WeWork was private at $10 billion valuation, and help me out. The one that's public. It was the Regis. I don't know the actual parent's name, but that's probably their problem. They have like 5 times the size of offices, but they were like at a 10th of the valuation. And I was like, oh my God, who's not looking at this trade? So to me, you can read the paper and find stuff. I love keying around special events. Everyone should set up Google alerts. Spinoffs are fine. My favorite actually is CEO change. That's my favorite. So anybody wants, CEO change is by far my favorite, by far. And it costs you nothing, dude. Like, set up a Google alert, change CEO. You can have it in 3 different ways. You can have it like CEO change CEO, like, chief financial or chief executive officer leaves, CFO leaves. You can, and that way you'll get the stuff, and you'll find a lot of times there's nothing there, but it takes 5 seconds to look through them, and you can see which companies are public.
All right. So, me, I interview a ton of management teams, for what we do at SNN. So, I'm going to ask you a follow-up question here, because this is fascinating. So what do you, is the trade
why?
that you're, well, no, not why. Well, okay. Why? Let's start why, and then we'll dig deeper into that.
Because it can't be, okay, I guess I am kind of screening it, but it's not quantitative. DFA and all these factor guys like can't really use it. Although I'm sure some people use it. I think a lot of activists use CEO change. It's one of those things. It's sort of sea change in a company. If a company's cheap and you get a new CEO, and a large shareholder is like, look, we just want to sell the company, the new CEO might listen. It's kind of like having a baby. It's like, hey, people are more likely to change their buying habits when they have kids. That's why, like, you're ridiculously marketed to when you have a baby. And the same thing's true, I think, of like a company. You sort of have this like sea change going on. It's like, okay, activists are now looking at it because they're like, oh, new CEO, maybe we can push on an open door here. Get this guy to put the company up for sale, or get him to spin off that sub you should have always spun off, or whatever, or get him to rationalize expenses. He can blame everything on the guy that just left. The guy that he used to work for. Oh, that guy's a bum. That guy's such a bum. He's a time waster, money waster, bum. And it's just a good. So you have all that fervor, and then I just think it's easy to change strategy. I think for me, one of the biggest problems with companies is just like, they're just not very dynamic. They're not run like in that very sort of creative destruction venture capitalist. I mean, that's why, like, I know when compound bros like talk about, like great cultures, they're probably right. Like, people with dynamic cultures probably will continue to innovate, whether it's like Amazon and Jeff Bezos and all the people that came up from him, or Tim Cook and Apple and things like that. These are amazing companies, but like, I'm not going to pay those multiples, and I don't think I have much of an edge looking at them because there's a gazillion people looking at them. But that's fine. People can buy them and make 10%. I don't think you can get in the 20% club or higher doing that kind of stuff. But hey, what do I know? That's my approach. What else are we going to ask about it?
Well, no, I mean, like it's an interesting strategy, because you're right. Most people would rather, invest in a company where they hope that the culture stays the same and you get that compounder over time. And, you want to make sure that whoever you're investing in, that management team is, or at least the CEO is going to be there for more than just 5 years. They're not just a hired gun kind of thing. But
well, I mean, yeah, I just think that, like, also sometimes, like, you'll see CEO will come in, stock will sell off, largest shareholder will blow out of it because they were there because of the old CEO. Now the stock's gone from 3 to 150, right? New CEO gone to 150, company could be in play, or maybe you don't even need it to be in play because now it's very cheap. But these are very discrete events, and you kind of have to be ready to move. So like for me as well, like I really feel like my investment approach, or at least my style, my sort of approach is very like preparation meeting opportunity. Like you're doing work, you're not swinging, you're kind of like, I don't know. And then like something comes across the plate and you're just like, oh man, and you just swing. Well, but I mean, I guess it is fat pitch, but the stuff that I do, I don't think would be appropriate. The aggressiveness, which is what I bring to it, I don't think would be appropriate for a fund with outside capital. So I have a huge advantage. Even guys in their PA, you have a huge advantage, guys and girls. You have a huge advantage because you don't have to. Who cares if you have a 30% drawdown? Like it's your money. Like so anyway. All right, go ahead.
I'd love to hear an example of this. You know, give us, you got this story time. Give us a story time where you saw that it came across the screen, you got the Google alert, CEO management change, CFO something, and you said, oh, I've been watching this company forever. Like, here we go. You know, time.
I'm not watching it forever, but I saw it last year. I saw sell side report. It's like, I don't understand people that won't take in information from alternative sources. Like sell side reports are great because they'll give you the quick and dirty summary of how the market's thinking about a security. Talking with management's great because they'll give you the quick pitch on like why you should buy their stock. Of course, it's not like, you know, if someone's selling you a car and they have an incentive to sell you the car, you're like, okay, well, that's really great. Let me just go online and make sure all that's true, right? The same thing is like if a company is pitching you, you're like, oh, that's interesting. They claim that their comps are double them and that they're growing faster. Oh, I'll have to like look this company up later. So you have to do some due diligence. It's not, but let's see, one where like I watched the company for a while and then management changed. I can't remember the specific name. It was called Neuro something. It was a net, and then the management changed, and it was a net management change, and the company was always considered cheap and a takeout target. So when I saw it, I was like, oh my God, this is like such a nice little setup. He's going to cut costs. He knows the company's in play if he doesn't get the stock price up, and it was basically a net. So it's stuff like that. I think it happens all the time.
Or maybe one that you weren't following for a while, you know, just one that happened to, you know, you.
Well, one that I hate to tell stuff like this because it makes it seem like everything is like goes to the moon. But one that the thing I made the most money on ever was I had researched this company called Orient Express Group. And I stayed at one of the hotels and I was like, you know, everywhere I go, by the way, here's another great, I'm a pro tip because I'm not a pro, but thing that I like to do is I always Google, man. You probably do this too, Bobby. I always Google like my kid's toy or like, I'm like, oh, this is interesting. This company, oh, it's owned by this company. This company's public. Well, it's like a $50 million company. So I will Google everything. I'm in a restaurant. Well, I don't know about restaurants, but I will Google everything and be like, oh, this company's owned by this company, which is like only $100 million company. That's quite interesting. So I'm always Googling like a company or a product or something to see if it's public or owned by a smaller public company.
I'm a label guy. I'm always looking at the labels. I'm like, oh, what?
Right? You know what someone should do? You know what someone should do? That'd be a really cool idea. Is like every product you could like scan it. You know, like you can scan wine. They have those like apps where you can scan the wine and it'll tell you how good it is or whatever. They should do that for like public companies. Because if you could scan it like with a QR, or not a QR code, but a picture, and then it would analyze it and tell you, oh, it's owned by this company, which is actually public, or owned by this private family. Like, that'd be really cool. Anyway.
That'd be pretty dope. All right, on the story.
Okay, so on this one, so I'd stayed in a hotel. I read the biography because it was a public company. I learned, oh, this hotel is owned by a public company. And I did some work on it. This is like 2000 and, gosh, dude, I'm not going to remember. I guess I'm getting old. I'm sort of forgetting years. So I stayed at a hotel. I thought it was interesting. It was called Orient Express Group. It was before it changed its name to Belmont. And I did a lot of work, and it was always like you'll run across companies like this, like a jewel box company, you know, like a great company, but like because of corporate governance or corporate structure, like it'll always be cheap. You know, do you hear that story? So there were a bunch of value guys that had been in it for years, and I have no idea why they owned it, because it was like, why would you own the thing? Like clearly it's just an ice cube, but it's not melting. It's actually okay because it was luxury hotels. So and then, you know, literally, so I read the biography, I learned all about the company, and really what the issue was from a corporate governance standpoint is the marquee asset had a ROFO, like a right of first refusal to the founder. So you could never sell the company unless you had the approval from the founder, because who's going to buy a luxury hotel group where it was the Hotel Cipriani in Venice, which, Bobby, I'm sure you've been to. I have not had the pleasure of staying at the Cipriani in Venice.
Oh, God, I've been to Cipriani. Don Kraft has been at the Cipriani.
Don Kraft. All right.
Yeah.
So when you come to Italy, we'll go to Venice or something. So that'd be fun. I've actually never been. So anyway,
me neither.
Yeah, there you go. Let's take the wives. Let's do this.
Yeah, let's go.
I'm sure it's appropriate for a 17-month-old, and I've got a 3-year-old. I'm sure they'll love us in the restaurants. What's that screaming?
Oh, they would absolutely.
They brought their kids. Anyway, yeah. So I read the guy's biography. I learned all about the company. Learned about the jewel box nature of the business. Then I'm literally just sitting at my computer and across BAM SEC, which I think everyone should use because it's $35 a month and it's fantastic because it gives you updates on all the filings and you can save stuff and you can search filings. And anyway, so it came across an 8K was filed. And 8K basically was a termination of this ROFO where the founder was giving the ROFO back for $25 million payment. And there was another little part of it where it said, if we sell the company within 6 months, he gets another $25 million. And I was like, wait a second. I read this guy's autobiography. I said biography, but it's an autobiography. The chairman of the board was his old personal lawyer. You think his old buddy's not going to give him an extra 25? Oh, by the way, everyone on the board, this was always a complaint in corporate governance, were friends of his, golfing buddies or somebody he knew from the industry, which, I mean, sometimes can be bad, but also it's kind of natural. How do you meet people? How do I meet people in my own work? So probably someone that I know who has experience in this, I'll bring onto my board or I'll suggest it as a board membership. It's not like PepsiCo where they're doing 100, they're going to a recruiter to find a board member. So anyway, so when this happened, I was like, this company is definitely in play. So on the 8K, I bought pretty aggressively. I had 30,000. I'll walk you through the numbers, but I only share it to be open. I did about $30,000 worth of options because that's really all I had in my PA. So I took it on 30,000 in options. They were I think I bought 2 months out, which I didn't even need to buy 2 months out. Literally 15 days later, they announced strategic alternatives, and the stock goes from 10 to 13 or something. And so now I can't remember what the exact math was, but my $30,000 is now $300,000 or 350. So now and the whole idea was, and to me, it's a very stake. I can't believe I'm going into the story in this detail. I'm sorry, Bobby. Do you want me to
apologize?
Tighten it up?
No, go.
Okay.
Full detail. People love it.
So I had the 300, 350, and I started rolling into other options. And I was speaking to my friends about the position. I was telling a lot of people hey, I think this thing is really going to go off with a 2 in front of it. This thing is, because if you do the math on the valuations for these kind of hotels, you could get some serious interest. I think in the proxy, someone that's a proxy nerd can go look it up. I think 60 or 70 bids were received for this, just to show you how much interest there was. But everybody knew this. It was so plainly obvious. It's just, I think most people just bought the stock, and they also didn't know about the ROFO being triggered if it was sold within 6 months. So I was planning it to roll out over the full 6 months to try to buy really cheap, sort of implied vol. I also thought the price was going to be a lot higher than people or the market maybe thought. So I did that. The stock slowly drifted from 13 to I want to say 17 or 18. So every time I was rolling the options, I was actually making money. So I was like, oh man, this is easy. And then in November, I got whacked pretty hard. And I think I lost $100,000 on the options because I had the 20 strikes and I was only paying I can't remember, 50 cents or something. And it had to be cheaper than that, but it's something like that, 30 cents, 50 cents. So I rolled the Decembers, and in December 23rd, it came across the tape. LVMH offered $25 a share, and I had the 20 strikes that I paid 30 cents for, and $100,000 with them or something. So I can't do the math, but I know it ended up being about $1.8 million because I guess I kept rolling it, so the capital kept going up. But I think back on that story, and to me, of course, I could have taken a bit of a bludgeon if a big bid didn't come across. And I think 25 is actually low. I think they could have gotten higher bids. But it was sort of a stake in Sizzle. It was kind of preparation meeting opportunity. It was doing things that others can't do because a big hedge fund isn't going to take some huge position in options. They would, but it would only be like 3% of their portfolio, like 100 basis points, 500 basis points. And so you could take advantage of that in your PA, like who cares if you're down 10%? Like, I'm sorry. Like if you're really trying to compound your money, like you have to be willing to take some risk, and you can't just, I hear people's personal portfolios and I'm like, they're like 3%, 5%. I'm like, why do you even bother? Like, just wait for something good. And I don't have a problem with someone having 10 positions, but when someone has like more than that in their PA, I'm just like, what are you doing? Like, you're not like a professional money manager. Like, well, you worried about like a 2 basis point move? I don't know. It's just my approach versus others. Okay. If someone wants to, anyway, I'll be quiet. What else, Bobby? Move on, because I've been talking too long about this. I'm terrible for your podcast.
Please, people are very. I know I just very much enjoyed that story and hearing the ins and outs. For me, it's because you're kind of the first one on here to talk about the idea of the steak and sizzle. At least in those terms, everybody has a version of it. I'm sure, you want to see something that, is good value, but then it has this sizzle factor to it. Right.
I get guys here, ask a question, but I get guys reach out about, they reach out about, not about special sits. They reach out about some value name. And I'm like, hey, that's really cool, but that's actually a really shitty business, man. Oh, sorry, I just cursed. I tried really hard not to
you're fine.
The whole time, and I cursed. And I'm just like, why? Like, okay, maybe it goes up 30%. Like, you still own a crappy business. Mm-hmm. Like, so I don't know. So I just have a problem when there's like no sizzle, and I'm just like, okay, maybe you make double your money.
But that's not to say but that's not to say a potential steak and sizzle story isn't talking about a business that's relatively boring. I mean, right? Like,
they could be boring.
There's a big difference between like boring and bad business. You could, Peter Lynch will tell you, like, boring business are his favorite, right? Like,
no. Boring in the sense of like, you never heard of it and it's not growing at some ridiculous rate, but the valuation's there and, you can find a way to express it. Maybe it's the stock, maybe even if it's a bankruptcy, maybe there's in the credit side. Or maybe it's even in warrants. Maybe in the bankruptcy, somebody got warrants. Now the warrants are just like penny warrants out there, and you really think this thing's going to double, and so you can buy warrants for 3 cents. Like, I just think there's opportunity everywhere. You just have to get, be as creative as possible about how to express it and what you can do, and just dig. But you got to enjoy it, Bobby, because this is, how this is. There's a ton of dry holes. Like, you're going to spend all this time on a company, and if you're really honest with yourself after a week, you're like, I don't know. And then you have to like move on.
Well, I think the funniest thing, in speaking of loving it and just being obsessed with it, I think we talked about it on the Investing in the Obscure panel that you were on, how like, look, if you're not getting text from Stephen Keel at 2 a.m. and you're not texting him back about ideas and what's going on in the markets, you might not be obsessed, which is okay. There's various strategies if you don't have this same level of obsession. But let's say there's a few retail people or just there's investors on here that not to say they aren't as obsessed, but maybe they haven't been exposed to the type of special situations or distress or have this level of interest in that you do. But maybe it's just because they haven't gotten exposure to it. Like, how do you help somebody that may be obsessed with investing or even microcaps specifically, but getting them to the point of like, all right, I want to be at Tom's level, like what do you do to help that could inspire them?
You get out on the field and you get your ass kicked around. I felt the need to curse there. No, you really do kind of like, Bobby, you probably, I know you spend a lot of time on the podcast and doing interviews, but you also have your PA, and I'm sure that by the way, everything I've mentioned I have owned. I was supposed to give that disclosure. Sorry, Bobby. Bobby's gonna like tattoo it to like the screen.
Don't worry,
Tom owns this.
I had it all right here. I had Hertz, the Goad you even mentioned, Namtai.
Did I? Okay. Yeah. Yes. Yeah. So all those I've owned or own. Most of them are done. They're special situations, but and I think it's you have to spend a lot of time in the market, because I do meet a lot of guys that are very good at doing the analysis, but they're very bad at position sizing, and they're very bad at knowing when to sort of really go in. And look, I'm not the end all be all of investing. There are guys that are way smarter than me. I'm just saying for myself, when I really find something, I go in pretty hard because that's how I've done the best. And, sometimes offense is the best defense in these things. And they're just different approaches for different people. And it can be a little gut wrenching to take, decent drawdowns. I actually, frankly, have not had huge drawdowns. I mean, when I was running my fund, I had a 28% drawdown in 3-month period. And you would have thought that like I had, I don't even know. I thought my LPs were going to what is it? Like quarter you, whatever the phrase is. I thought there's going to be a lynching or something. But you can't, that's when you run a fund, it's very different. It's outside money. You have to be able to really explain yourself, communicate well. I'm not sure I'm the world's best communicator. And that was tough. So I think a lot of it is communicating strategy, finding like-minded people, and also getting lucky, with vintages. My friend, do you know Shai Dardashti? It's been a while. I don't know. He used to work at MOI and Manual of Ideas. And he was like, if you look at special sit managers who are like big, like $1 billion plus managers, they all kind of come from the same vintage years, which makes sense. And I'm sure there's some empirical research on this, but like all strategies, like a lot of those quote unquote great track records are going to come from vintages. Like the best VC guys are going to come from like a cohort of vintages, and the same with PE, and the same with like public market, either value or GARP and things like that. Like, I mean, I'm sure, Kathy Wood is a great investor, but you have to admit, like, her cohort, where she's coming into the market and where we are in the markets helps a lot.
Well, Tom, because I get the sense from you, like from not just this interview, but from the roundtables that you participated in, is that you had this nature about you where like the risk and
when I was
going offense.
When I was a kid, when I was a kid, I used to, my parents are bank dealers. I used to sit in bankruptcy court waiting for my mom to get out. We used to go and be like, oh, this thing is this like, I remember when I was a kid with baseball cards. The baseball card shop was closed. Everything in here is for sale for $3,000. Like, do you want to buy it? Like, we should buy, this is the kind of like, so I had a little bit of that as a kid. And so it's like economic dumpster diving. But, ask your question. But I mean, I kind of grew up with that, a little bit of that mindset. Like I used to go to HUD auctions as a kid. And I actually did flip a HUD house. I don't know if it was profitable. I'm not sure what my parents were thinking. I mean, honestly, I think back, and I remember once my brother we were doing our own demo, and like you have to you do your own demolition. And my brother and I were like cutting cabinets off the wall, and like cabinets falling down almost on us. I'm just like, well, my parents must have really been, need to head examined. But anyway, what was the question? When did it become more steak and sizzle?
Well, no, like I'm just asking, like just a characteristic trait, it just, you give the vibe that it's more about the love of the game than really, I lost.
Yeah.
Okay. Like it.
But
it's pretty fascinating.
The outcomes don't matter. In my mind, the outcomes don't matter at all. If you did a dumb trade and you made money, I really don't give a shit. Like, I think again, it's kind of like a setup. Like, how beautiful was the setup? Did you take advantage of it? And did you sort of, bet big when it was time to bet big? Like, I think that to me, that's how I kind of view things. And, I see guys that make a lot on a trade or an investment. We can say investment if everyone wants to make it sound polished. And I think that it's good on them. Good on them. I mean, and, seeing things before other people is great. Seeing around, if you can see around a corner because you know a lot about a space, that's fantastic. I'm not that smart. I really have to just stick to financial stuff, so I'm not a domain expert, and it's a technical dynamic that's making a security very cheap, right? Like Namtai, which I owned. Okay, I don't own anymore. I guess I should say that. That Steve Keel and I were talking about. These are people getting shaken out of a story, and they were kind of spooked by it. And some special sit guys came in. And then when things got a little hairy, anybody that was a deep value guy that owned the stock was just like, I told you these guys are going to screw us. I'm out of this name. And the stock got way cheap. And that's the beauty of public markets is you can take advantage of the marginal buyer and seller. You could never, ever buy that stack of real estate for $5 a share when we were buying it. And that's what you can get in the public markets. And then if Steve, like, I shouldn't speak for him, but there are a lot of people, maybe Steve included, I don't know, talk to Steve, who were expressing it through options and they crushed it. I should have frankly bought options, but I was just too busy with other work. But it, that's me. And the Steak and Sizzle, by the way, there's a great interview with Michael Price. That's who people should really listen to. I think it's at Columbia, might have been NYU actually, and he walks you through this idea of Steak and Sizzle. So he kind of walked you through like, well, this company just got bought for 10 times. This company is trading for 4 times. An activist just showed up. It's actually a better business, but they need to break off the businesses. So if you get rid of the European division, the American division is actually a better business than the one that just sold for 10 times. So this kind of idea of, and him as well, like company was cheap. Now it's being sold. It's being sold at cheaper than the comp. Maybe they get a bump. Maybe it breaks, but instead of if the merger breaks, it going down, it goes up. Like I know a lot of guys are in this home thing. I think the symbol is home. It's HOME, and I totally love that trade. I wish there were options. The option guys have gotten out of it. You could potentially buy it. I don't own it, full disclosure, but I've been considering it. But I just think that that's a fun and profitable way that I do things. I mean, some guys are a lot more conservative, and they're maybe a lot more like net driven, or they are using big DCFs. I have no problem with that, but I still think you can get better finding scuttlebutt than doing big DCFs. But go ahead.
Very good. All right. Well, before I let you out of here, I got. Listen, you've been tweeting a lot about GoDecker. I know you mentioned it a little bit earlier, but give us your GOED thesis here. I never do this, but you have been tweeting. Yeah, you have been tweeting about it a lot, so I have to ask. All right, so what?
What's funny is we were going to do the pod last week, right? It was my fault. Yep. I tried to dial in from the beach club and it didn't work. So now I'm at the you got me tethered to the desk here. And I am quite long, so I'm not trying to shrill or shill a position. I guess it's shill a position. But they did a private placement. I originally had sort of looked at the private placement. I had a friend who reached out to me about it. He was like, "Hey, have you looked at this?" And I was like, "I wouldn't touch that with a 10-foot pole at $4 to $5." And then, I was like, very interesting. If they pull it off and there's execution, maybe the stock gets cheap when we look at it. Then I saw the deal come across the tape. It was $225 a share plus a warrant at $225, and I was like, "Wow!" And the stock was down. I can't even tell you. It was down 80%, 70%. And so that afternoon, I was like, "This is when this could be interesting because now the stock's at $1.80 and the warrant's trading for 40 cents." So I went pretty aggressively. Very aggressively for most people, but I've been buying all the way up, frankly. I have another theory, which is you're probably better off averaging up into your positions than averaging down. I know everyone thinks like, "Oh, if you liked it at $1, you're going to love it at 80. Bobby, I want to ask you a question. When's the last time you loved the stock at 100? Now it's at 70 and you're just like, "Man, low." You should if you really believe in the thesis and you've checked it, you probably should average down. But for myself, I actually have done better over time in things that I've averaged up into, meaning that they've worked and I've anyway.
Got it. All right.
You didn't answer.
You want me to answer?
Yeah, I want to know.
No comment.
No comment. Oh, all right. One day I want to do next. Can we do next week? I want to interview you because I want to get your philosophy. You interviewed tons of investors and tons of CEOs. I'd love to see for myself, Tom, I'm not learning anything by talking.
I'll tell you, I said this on a podcast before, so it's okay. But full disclosure, I don't manage my a personal account.
Oh, you index. Oh,
no,
okay.
I don't, and I really don't have any money in the market at all. I only own a little
No
bit
way.
of Bitcoin. The main
Wow.
and the
Oh,
main
I own a
reason,
little bit of Bitcoin. He says
Yeah.
under his breath.
yeah,
Under his
a little
breath.
bit of Bitcoin. No, but the main, I mean, look,
A
the
little
main
bit
reason
Doge.
being, the main reason being, as you know, like I interview
It's
so
hard.
many
Yeah, you
companies.
have not conflicts, but you're talking to a lot of companies. Yeah.
Yeah, I mean, we have good compliance at SNN where we have a 72-hour rule where you can buy and sell 72 hours after you
I was getting
publish
nervous.
an interview or something like that. No,
Is it hot in here?
I've talked about it. No, but at the end of the day, I mean, the main reason I don't invest though is I put so much time into building up our media businesses that to be the type of investor that I want to be, like you, like Steven, like everybody who I've talked to on here, is you guys put all the time.
You got to really devote
into
yourself.
that, and I just don't have the time. Look, there's so many ideas that I've come across that I know for sure no one
will call me next time.
Yeah.
Well, call me, Bobby.
But, so
I be on the hotline.
My net worth could be way higher than it is, but it is what it is. I like this.
3 a.m. I'm up.
Yeah, I know.
You can. Thomas,
I got this other distressed. I got this one distressed asset. It was the Mt. Gox competitor in 2012.
No, but it's interesting you say that. I have no problem with that. And you know what? You bring up a good point is the best investment for the most part can be in yourself. Like, I really believe that to be, and we're really getting like, the best investment advice I would give people, invest in yourself, but yourself, your business. It is very hard to make high returns on invested capital in the market. And people that think you're going to retire investing in the market, like, I don't know, like you retire investing in other people's money in the market. Sure. But like, even if you compound out at 20, it's very hard to just live off of that.
And to be fair, like before I made the concrete decision of like, hey, just focus 100% on investing in yourself, investing in your own business. When I was investing, I was investing in other people's convictions. And I just hated it. I knew I was always uncomfortable. I was looking at the stock every day. Because I didn't build up the thesis for myself. I was like, okay, what does this mean? But what the person that I invest, what do they think this means?
Yeah. What does he think this means? Right.
Yeah. And like, this is not the way I want to do this. So,
that's why I really think the best strategy is the one that fits best with your temperament and what, for myself, I like the high octane. I like stuff that's I guess, I don't know. I don't want to say high octane. That might sound risky or something. And I guess it is, but I really think investing in yourself is absolutely the best thing you can do. And, people that there's, the Double Your Profits in 6 months or less is like a famous book that everyone reads or talks about reading. I don't know if it's like read it, but they talk about reading it. They talk about not spending money on non-strategic things and then overspending on strategic things. Like, I can't think anything more strategic than yourself, like your knowledge, and maybe it's not always just like overspending on a business, like, oh, I need higher production stuff, or I got to buy this new laptop because I got to have this, you convince yourself of things, but truly investing in yourself and the returns on invested capital from your own business are going to be almost impossible to beat in the market. So like, that's for show.
That's the bet I made, but
for show.
Yeah. All right, so Tom, we're rounding the corner here. So I mean, for investors that relatively new to the market, they're hearing this interview and they're like, "Damn, like I want to be that high octane guy that Tom is." What advice do you have for them?
I mean, if you love it, dude, just go out and do it. And be forgiving of yourself, but don't be easy on yourself. Like if you're putting real money, like you need to sort of try, not just do the work, but put in the time of, for myself, I feel like over time, I made more money on ideas that are quite simple, but that I just reacted very quickly and my decision-making was faster and my ability to sort of, to quote unquote, go for the jugular, as Soros would say, was a bit higher than most people. And that's really just with experience of being out there. When I was young, I probably did more work on companies and yet my returns weren't as good because it's not about conviction. It was about like probably letting mediocre things get into the portfolio and also probably taking like management stuff and being like, oh my God, this is amazing. Like the management's telling me this and that. And now I'm a little like, oh, that's really interesting. And it's not that they're bad people. It's that there's an incentive for them to give you, like, this is basically the bull case. So, you sort of need to set both sides, but you can't, you got to get the merch going. Come on, Bobby, invest in yourself, get the merch going. I'll buy it.
Tom, I have inquired, so it's coming. You'll get the first design, and you tell me if it's lame or cool.
It could be lame. Cool. It could be cool. It doesn't matter, man. You just got to get it out there. I don't want
to put out lame stuff, man.
Iterate.
I don't want to put out lame stuff, man.
It's gonna be from you.
Actually, the only thing I really care about with merch is that it's a comfortable shirt. Whatever it says, that's fine. But as long as it's a really comfortable shirt, like I know I own shirts that like I would never wear in public, but they're damn comfortable. You know what I mean? You just want a comfortable shirt.
I don't know what you mean. I don't know, man. I don't look. This is like basically I've been wearing the same thing since I was a kid, a polo shirt. So I don't have a strong view on this topic.
Listen, I can't remember the last shirt I bought I picked out. I don't know fashion, but so anyway, so this is.
You gave me such insight.
That's the guy who's defining some shirts
in the market. No, the fact that you're not in the market, I think that's really interesting. I want to break this apart. I want to hear about. You know what you should do? Actually, you should think about. Gosh, I don't mean it. Should we do this on air? It'd be interesting. Those like personal finance channels where they walk you through their personal finance. Like you're already doing finance stuff. Like why not like open it up and like break apart your business like these guys do? I think it's quite interesting.
I make have you ever heard that podcast Startup? It's like kind of like that. No, you haven't heard that?
Oh yeah,
like
Startup, where they do a podcast about their startup, and then the startup is the very meta.
Very. All right, Tom, with that, it's time to, look, you're in the Italian countryside. I know you're very, very, you're trying to get out of there. I'm going to
play tennis now.
Yeah, you're going to play tennis now.
Like this is. I swear to God.
Yeah, no, so I want to let you go. So, Tom, where can people go find more information about you? Follow you on social media.
I'm on Twitter, and my publicist is Bobby Kraft. It's Bobby. I don't know where you find him. You got clearly somewhere in like a ship blueprint room that he's found himself in. I don't know.
My ship blueprint room. That's right. That's good. But so you can find him at what is it? It's at Thomas Braziel, right?
Yeah, I think so. Pretty sure. Yeah.
Hold on. Let's check.
Find me on Twitter, and then I have a website and I'm on LinkedIn, and I don't mind either one. That's just some of the platforms. Like Twitter, there's an idea. I like that. That's a Sizzle. They're definitely going to monetize. Disclosure, I'm not long anything, but I love the idea of the leaps on Twitter because Twitter is great. So if someone wants to look me up on Twitter, do you talk to a lot of people over Twitter?
Oh yeah, I love Twitter. That's probably my favorite. Like LinkedIn used to be, but now
LinkedIn sucks, man. I use it for. Yeah, go ahead.
You were saying.
No. Go. Come on. I don't learn anything if I talk.
For me personally, I'm not a big fan of LinkedIn. It has its use cases for certain things, but like I'm just sick and tired of getting hit up by every person saying that they're they have the right Salesforce CRM strategy or animated video producer. If I get another one of those, I think who knows, man.
My favorite is when they reach out to you and they've got this big like service that like a Fortune 500 company would work. You realize it's just me, right?
Yeah, no, I just like, but I've gotten, I get the most value out of Twitter. I haven't really tapped from a working perspective, Instagram, but I don't know how to use it. I think it's pretty interesting. It at least when I think about media, it's all about like the type of content that you're going to put in there. And I don't know. I don't know if I'm the guy that I know how to create those like short snippets that work in that environment. But Twitter, I've been a big fan of like Twitter, stock twits, FinTwit. I don't really use stock twits anymore, but back
I don't really use any of that stuff. Stock twits. I like Seeking Alpha, by the way, which we're talking about it. So BAM SEC, any screens are great, but I don't use screens that often. Although I do like Toby Carlisle, I get his Twitter stuff. Twitter is fantastic. And some of the Substacks that people put out there, I really find them through Twitter. Some of the work is great. I mean, these are like international compounders that are just great little finds. I mean, I don't know if you're not going to get rich quick doing any of that stuff, but some of these companies will be great little compounders.
Yeah. All right. So you can go and you can follow Tom on Twitter at Thomas Braziel, and that's Braziel. And you can also go and his main website for 507 Capital. It's 507capital.com, right? Yeah.
Yeah, man. Call us. If you got ideas, let's talk.
Nice. All right, dude. Well, with that, I'll let you go. Always a pleasure, man. And
thanks,
I'll see you on a roundtable soon.
Oh yeah, bro. All right. Bye-bye.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. This episode of the Planet MicroCap Podcast is brought to you by Friedman LLP, a top 40 global accounting, tax, and business consulting and advisory firm, providing a full spectrum of services for public and private companies since 1924. Contact Friedman when you will need to raise capital and adhere to U.S. standards. The Friedman partners will work diligently with you to provide the financial assurance, regulatory, and transactional services you need. When the stakes are highest, Friedman makes sure you are well equipped. For more information and to get a Friedman free consultation, please call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com. Again, for more information and a free consultation, call 856-830-1660 or email Neil Levine at nlevine@friedmanllp.com.